Hello. Nice to see everybody again. Hi, Jeff.
Hi.
So
Nice to see you.
Most of you, I gather, were with us for the morning session, so you probably know me and maybe a little tired of me already. If you weren't there, hello, my name is Eli Braverman. I'm co-founder of Betterment. And Jeff, I don't think the group has gotten a chance to meet you, so why don't you say a few words?
Well, I haven't been around as long as Eli.
Yeah.
We got started a few years later. But yeah, I'm Jeff, co-founder of Acorns, and really excited to come out here. It's my first time to Malaysia as well. And I think today we want to open this up to as many questions as possible. And I think in the beginning, just give some background on our experience building our companies. And I think the theme is it's hard, it takes time, and there's a lot of early mistakes and insights, but you can't really escape from the hard work that is required to build a real sustainable business. And so I think I'm going to take a few steps back and talk a little bit about Acorns, and then we'll share a little bit more on Betterment, and then open it up to some questions. So we started Acorns to make the big decision to invest, a smaller decision. When I was in college, I found that most of my classmates were interested in investing. They wanted to become an investor at some point, but they didn't think it was possible. And at the time, the smartphone was becoming more ubiquitous. This is in 2011, 2012. And increasingly, you could do more on your phone. You could get car insurance, and you could bank sort of a rudimentary way. But you couldn't really open an investment account. And Schwab and E-Trade, they had investment apps, but they were more for existing customers. And our other goal was to distribute investment accounts like an app and not like traditional financial services. And that required us to create an investment experience that was app appropriate. So we wanted people to open an account in a few minutes using information that's top of mind. And finally, we wanted to reduce that emotional friction associated with making your first investment. And picking an investment is a pretty big decision. And so helping people make that decision initially is important, because if you ask people to select an investment, they're going to tend to think about it. And they're going to tend to maybe call that uncle that's good at stock picking, or talk to a professor or someone else. And before you know it, they've left the onboarding. And next to that, we wanted to help people find the money to invest. And so that's where the spare change really came in, because we wanted to help people find the money to invest, really in the background of life. Now, to do that, we needed to build a platform that could carry really small accounts, that could transfer small amounts of money, and can service many, many thousands and millions of accounts economically. And that ultimately required us to build our own clearing firm. We didn't plan on that initially, but the infrastructure to power Acorns is actually 3 companies. We have a parent technology company, we have a broker-dealer, self-clearing broker-dealer subsidiary, and an affiliated investment advisor that can give the recommendations of what to invest in. We custody the actual accounts at the broker-dealer, and it's really all managed by the parent technology company. So it took us about 2.5 years from initial ideation and incorporation of the business until we launched. And some of the hardest decisions for us were committing to actually building the regulated part of the business. And I really think that having a part of the business that's regulated is actually a big help for startups, because there's very little that's defined initially, and having some rules is actually helpful in terms of getting structure.
Did you look at other options, at some faster paths to building out the brokerage services? And how did you know that none of those were as viable as building your own clearing firm?
We didn't initially, and we didn't want to build a broker-dealer in the very beginning. Fortunately, we did. It ended up being a very valuable part of the business. And in fact, I think that it would be difficult for us to have really innovated if we were handing off the investment accounts and the account opening off to another entity that didn't share our vision. It wouldn't be a great experience for the customers if they were passed through to another entity with a different name. But I think more importantly, if we were to really scale onboarding, it would be difficult to open 10,000 accounts a day with someone else. Just they would have to onboard so many people to handle the compliance side of it that it would be difficult to scale. And scale is the last thing that we focused on, or the last important point, I should say, of the business. Acorns was built to scale. In fact, the business doesn't work without scale. And so to really handle the numbers of trades, to carry the number of accounts that we needed to, we had to build out our own clearing firm to scale, not just own our own proprietary trading platform.
How many of you in the audience have a startup, have a fintech startup, have had a startup in the past? Okay, great. Well, we want to.
Oh, more hands are coming up.
Come on.
Slowly.
Anybody? And now raise your hand if you're thinking about a startup. Okay, great. Well, we're going to come to all of you in a few minutes. We want to open this up. I think this is a great opportunity to engage. Let's talk about hiring a little bit.
Okay.
I feel like we spent as much of our time as we could trying to hire, just trying to get some early team members to come on board and to believe in the dream, at least once we had a little capital lined up. And it was hard. Getting those initial team members, the first 5 was a lot harder than the next 20. It's a real leap of faith at that early stage. And we found, particularly for engineers, that was the hardest because engineers have so many options in front of them for where they can go work. And there's a lot of paths that are a lot bumpier than an early stage startup. When we got to a critical mass of engineers, when we had built an engineering culture and we became known as a destination for really great engineers in New York City, it really accelerated the pace of being able to build out the team. I'm curious what the experience was like for Acorns.
Yeah, I mean, it was slow going initially, and I think it's probably a good thing that it's a bit tough in the beginning. I think, hiring, raising money, finding customers, these are very related concepts for a startup. If you're good at convincing other people to join your mission and help you build your company, it's probably likely that you could, raise money for that and hopefully get customers as well. And in the very beginning, the idea may be clear in your head, but communicating that is a bit of a challenge. It's not necessarily as clear when it comes out, and it takes practice. And so meeting with investors and meeting with potential team members to bring on board and getting their feedback is excellent in terms of developing the initial structure for your company, an idea. And part of that's taking feedback into consideration, getting asked tough questions that you may not know the answer to. And the more you do it, the more good feedback you get. And I think that after initially pitching many very smart investors and being told no, the presentation changed quite a bit. And it's almost like the scar tissue from all the no's and feedback is actually what ends up remaining for the startup at a certain point. So accepting that your startup isn't going to be perfect when it begins, but if you can make sure that it can improve, I think puts people and companies in a better position to succeed.
How much money did you raise when you raised your first outside round?
We raised about $2 million or so.
Do you remember what you were targeting to raise? Was it less? Was it more? Was it $2 million?
It was more. It was that was more of a friends and family round. I mean, it was outside money. We had been talking to some investors up in Silicon Valley. We weren't really ready for that. Mm-hmm. And the very first money that we raised was just sort of family. It wasn't a lot. And on one hand, when we sort of went through that, it was like, oh my gosh, what do we have to show for this? But we knew what we didn't want to build. And we did have one outside investor at that time. And What we decided after working on it for almost a year was that we really needed to build our own broker-dealer. And that would have added another 18 months and tripled the cost really to build before launch. And it was the right decision. It was a great decision. Our investor was supportive, and we made some more progress towards our FINRA approval, and then we raised our $5.5 million outside round, our big one, and one that was right before launch.
I think that timing and quantifying the right amount to raise is one of the most daunting questions in front of founders at the early stages. It becomes a lot more clear in subsequent rounds. It's sort of, you have a multiplying effect. But when you go out to raise that first capital, I think people are really unclear. Do I want to raise more money? Should I raise less money and try to take on less dilution? And I have a lot of conversations with founders today about that, and there's never a clear answer. But I tend to gravitate towards raising more than you think you ought to, taking capital when it's available. When we set out to raise our first outside round at Betterment, I mentioned earlier, if any of you in the room remember, we bootstrapped for a couple of years. It was a very lean operation. And then we thought we'd raise $1 million. We wound up raising $3 million, and it was very fortunate that we did that. We would have not had enough capital to really prove out the business on $1 million. We thought, well, we'll get $1 million, and then we're going to have all this fabulous traction, and then we'll go back and we'll raise $5 million on a 5x valuation. It wouldn't have worked out that way. If we had raised $1 million, I think the business would have failed.
Yeah.
So de-risking it like that was very important.
Well, I think, you don't have to know how you're going to get there on day one. You know you're going to get there. You have a vision, but, part of the process is discovering how exactly you're going to get there. And in terms of the companies that we've built, that meant building, self-carrying broker-dealers, investment advisors, and, designing a very, user experience first product. For us, I think that we were lucky that we were able to sort of raise a little bit more after we decided to pivot towards building some more infrastructure. I do think there's a really big difference between raising a big round when you have product market fit and you're focusing on scaling. And I think experimenting with paying to acquire customers is important. I think a lot of startups out there, they're excited because they can acquire or find a lot of enthusiastic customers without paying for them, which is nice. But if that's all of your data and you want to go raise a big round to acquire customers, it doesn't really make much sense because you don't really have a good grasp of how much it costs to acquire your customers. So I think discipline around paying for customers, acquire growth is important, and some experimentation is actually useful. But also knowing when to time that at an appropriate stage. When you're building the product, it's probably not a ton of help because you're focusing on just making the product work for your customers. But after that, it's more useful.
And ultimately, you've been a very successful capital raiser for Acorns. Why don't you enlighten the crowd, the group?
A lot more successful after we launched.
All the secrets of how to raise venture capital successfully.
I don't have all the secrets.
Make everybody an expert.
I think it's show, don't tell. I think that it's a lot more difficult to communicate your vision if you don't have something to show people. People are busy, they don't have much time, there's a bunch of other things going on. Having a prototype, something that you can put in someone's hands so they can really see it, is helpful. And it's not expensive to build a prototype. Find a way to build it, to make it something. For one, it's good for you to really see your own vision. And I think one of the most powerful things about building a company around a product, I think building a great product is an important aspect to a startup, and then building a great company is how can you sustainably build and support great products. And when you find someone or some people that you can work with that can help make the things that you're thinking of better than you can, it's like a spiritual experience almost. And so the closer you can get to sort of prototyping, designing, if it's a consumer-facing product, really understanding your market, I think it becomes a lot easier to raise money. And also, don't be put off by being told no. It's okay. That's what most people say. And that means, hopefully you can get some feedback. And we were told no, 50 times plus, to like 100. I've probably been told no over 100 times. You take the feedback into consideration, and a no now doesn't mean a no later necessarily. Thoughtfulness around taking that feedback into consideration. And sometimes it's not. Sometimes they're wrong, which is okay. So I wouldn't, give up if some feedback doesn't seem positive initially. And in fact, if you're onto something and everyone sort of rejects it, that may be a sign that there is an opportunity in that area.
Yeah, I think that point about tenacity is really important, right? I think good investors are looking for that. They're looking for somebody that doesn't take no for an answer. I also think building a relationship with investors, not necessarily expecting something from them tomorrow, but knowing that if you get them close to the story, and then you go execute on what you tell them you're going to do, you're setting yourself up for future financing. That happened to Betterment. We pitched a firm called Menlo Ventures, a very well-known, high-profile.
They told me no.
They told you no. They told me no, but they told me yes the second time. A lot of folks who I pitched said yes to you, but we pitched them for our A round, and they couldn't get around to it. But they were the ones who ultimately led our B round, and part of it was developing the relationship. I think part of it also is good investors, seasoned venture capitalists. They are used to entrepreneurs promising the sun and the moon and then not delivering. We actually went out and executed on the projections that we had, and that meant a lot to them.
Yeah, doing what you say you're going to do is one of the most valuable things that you can have or do as an entrepreneur. If you have modest goals and you meet them or exceed those or reach those, then that's great. A lot of startups talk to sometimes, then they lay out their vision, what they want to accomplish. They say, oh, we'll have a lawyer that'll handle this part. We'll have a designer handle this part. And, oh, this part's easy, this part's easy. And it's like, well, if you can't do the easy parts, how do we know that you're going to be able to do the hard parts? Get the easy stuff done. Some of the busy work, get that stuff done. In the early days of a startup, there isn't a ton of work every day. Sometimes it feels like you're just kind of sitting around figuring out, who to call, waiting for people to call back or email back. It's not like go immediately on day one. And it's okay if it's like that. But as time goes on, making sure that you really respond to certain opportunities. Certain opportunities come up, and you seize those, whether it's opportunity to meet someone or take a connection. Basically, say yes to lots of meetings in the early days, because you don't exactly know how you're going to get there, but people that like what you're working on and like your idea, those are probably good people to keep around if they're enthusiastic about what you're working on. And not just like blindly, but if they really believe in it and want to help you, then that's helpful. I've spent a lot of time trying to chase people that weren't crazy about what we're working on. And I think sometimes the entrepreneurial drive, you want to get someone to say yes, that may be tough, and it's not always helpful to convince people that don't exactly love what you're doing.
I love what you said also earlier about showing, not telling. And it goes to something else that I think about with investors, which is, the attention span is extremely short, right? You have very little time to make an impression with investors. And, if any of you have ever used a DocSend or a similar platform to send around a deck to raise capital, you can really see this well using those platforms. I encourage entrepreneurs to use that, because you can track how people are engaging with your deck and if they're reading it and what slides they're skipping over and what slides they're spending time on. And what I found, which is so interesting, is if it's a no, it doesn't take very long to get to a no. I mean, it's less than a minute. I usually see somebody spend 30 seconds or 45 seconds on a deck. I mean, that's a no. That's how long you've got their attention for. And then more interesting is if it's a maybe. It's never going to be a yes right away. But if it's a maybe, I might be interested in this. It's still only 3 minutes. That's how long people spend on a deck for an idea that they think is really interesting. So you have to grab a hold of people very quickly.
And I think also when you do your homework, earlier I mentioned, sometimes, the entrepreneur wants to say, oh, we'll hire a lawyer to figure out the regulatory side of things, or we'll hire, an engineer or a CTO to look at the tech side. And in those early days where you have some extra time, read the rules, read up on tech stacks, spend that time becoming an expert of sorts. You can do it. It's not impossible. It's just somewhat tedious. And in fact, I think in financial technology, one of the most important things for entrepreneurs is actually to spend time reading the rules, spend time on understanding the regulatory environment to really become an expert, to have a grasp of that. I think it's almost impossible to lead a business in the space if you don't have a firm grasp of that part of the business, because it'll always be nagging at you and potentially, the cart leading the horse to an extent if you don't have, confidence on that side of the business. And I think another part is history, making sure you study history, not just history of other startups that may have, attempted to build a similar business, but, finance has quite a rich history and long history relative to technology. And I think that there are so many technology companies out there, and Fintech is, I think, interesting because of the fin part. And diving into that history of finance and looking at a lot of the problems in finance and looking at a lot of the sort of more archaic parts of the industry and parts of businesses is really a good way to come up with ideas and solutions to build using technology today. And at Acorns, when we dove in and ended up tackling the clearing and carrying side of the business, we were able to build better technology. And ultimately, we had frustrations on this proxy processing side of things, which is related to shareholder voting and proxy distribution. And that ended up leading me to co-found another company called Say to build a better solution, initially for Acorns and now for all broker-dealers. And we wouldn't have seen that opportunity if we didn't say, hey, this experience kind of sucks. Why are customers getting these ugly emails? Oh, this is actually related to their rights as shareholders. These are notices about shareholder votes. Oh, voting, that sounds important. This sounds like an actual, potentially an experience for shareholders. I mean, they have the power to vote their shares. Something should exist here. And, why have people forgotten this? Oh, well, there used to be stock certificates. Those sort of went away as we streamlined the back office. And shareholder meetings also kind of went away when, investors were more distributed across the country. Oh, okay, well, with that, some of the memory and knowledge around shareholder voting kind of went away. And so I think history is one of the richest sources for inspiration in building startups, and also for potential lessons and insights on what to do when certain problems come up or certain opportunities come up. I think it's very rare that an entirely new problem or unprecedented situation is before us.
I thought it might be interesting. We got a question from the audience on the iPad. I think we're going to switch to maybe handing some mics out or having people come use the microphones. But as we do that, maybe we can get that ready so people can ask questions live. Let's talk about partners for a second. I have some things to say about my partners at Betterment, but you start because,
I co-founded my company with my dad.
Your partner at Acorns, huh?
Yeah, my co-founder. I've known him for a long time, my entire life. So I think I can trust him. And I'm very lucky. My dad's been in the business since he was little, and his dad was in the business, and his dad was in the business. And he talked about, capital markets all the time when I was growing up. And he was an investment banker, and if he was raising money for a comic book company or a video game company or candy company, I was more interested in the comics books, candy, video games. But he would try and connect it to capital markets a little bit. And he's obsessed with history, and would often share a lot of those lessons with me, both about the family and also about finance, which sort of gets more attention when there's a crisis that comes up. People seem to be a lot more reflective on, well, what's happened before? And then when there isn't a crisis, people seem to think, oh, everything's new. This is unprecedented. And so it was exciting to build a company with someone I've been talking to my whole life about companies, and really one of my best friends. And I think having the right partner is also the right person that can understand, it takes some time to really find your groove in a company. And you're imperfect. And so your partners need to see past your imperfections, push you to be better. And so a lot of mutual respect is essential to be successful.
You had it easy on the trust side of things, because.
But parents can kind of drive you crazy.
It's true.
It doesn't mean they're wrong.
But I think it's the most important point of picking a good partner. I actually had two partners to start out at Betterment, but the one who lasted, both of them very, very good, very super trustworthy people. John, who still runs the company as the CEO, I'd known him for, I think, probably 4 years when we decided to go into business together, and he was obviously a very capable person, extremely, one of the most well-rounded intellectual minds that I've been around. But it was the fact that I thought, he was a good person, somebody who was honest to deal with, who would be reliable, that really, I thought, made it a no-brainer to work with him. And having looked back at the last 10 years, I have almost exclusively great relationships with people I've worked with, and there have been a few trying relationships, and I always look back at those and think, you got to check with your gut a little bit on people. It's so important. You got to have the right feeling in your gut. The other thing I'd say on partnership is, so we had another partner early on, a wonderful guy, it took us some time, as we've talked about, to get going, and his life was just sort of taking him in a different direction. So he decided to bow out at an early stage. And one of the things that we didn't realize it was so smart at the time, but it turned out to be really smart, is we had a partnership agreement that provided for what was going to happen if somebody left in the early days, and provided a vesting schedule, essentially. And that was so important because we all decided, when we were on the same side of the same team, how we were going to treat that situation. When he decided to leave, it was very clear what to do, and there was not a second of drama or fighting. It was all predetermined, and so it's something that I would encourage people who are forming partnerships. So first of all, I'd say I think having a co-founder is a great way to build a business. I think it's the preferred way to build a business. But I would think about, what happens if somebody wants to bow out. Should we open it up? Do we have some questions from the audience? I'd love to hear from the founders, the aspiring founders, and everybody else in the room. Or do we just have a bunch of, maybe some shy?
Was there an iPad?
There is an iPad, but it's locked.
Oh. Do you want to unlock it?
I think we have a question over here.
Okay.
Hello, my name is Araminta, and I am a Fintech copywriter. So I'm very interested in financial education. Mm-hmm. And one of the big reasons that I love Fintech is because it empowers people to financially educate themselves and to understand how to manage their money. So my question to you is, I already actually typed it out, but I'll just say it again, is do you think it's fintech's responsibility to financially educate citizens? And how can fintechs use that to build trust, add value, and just improve people's financial well-being? Thank you.
You know, I'll go first. I don't actually think it is the responsibility of fintech companies. I think that's something that they can elect into. That's your choice.
Their opportunity.
Opportunity is a good way to put it. But I also think, there's different ways of doing this, right? There's something to be said for education and teaching people how to take care of their finances better. There's also something to be said for just doing it for them, right? We need to strike the balance. And I think we talk a lot about financial education, and for good reason. But we also need to work really hard on making things easier, simpler, more accessible. That's important as well.
I think if you can get someone to pay attention, if you have attention on something interesting, which I think fintech generally deals with sort of a more interesting aspect of someone's life. It's something real, right? There's money involved, there's investments involved, there's something sort of greater at stakes. And I think that attention is something precious. And if you can use that attention to make your customers smarter on something, then that's an incredible opportunity. And I think in some cases, when it comes to investments and other things, certainly it's a responsibility to make sure your customers understand what they're signing up for. But what's interesting when it comes to investments for us at Acorns, because we brought the threshold to investing down quite a bit. And we find that customers, even when they make a $5 investment, are more interested to learn about their investments once that's made. And we could spend a lot of time trying to educate customers on the investments before they make that $5 investment, but it's a lot more difficult. And so you have a sort of naturally more engaged customer oftentimes, because telling someone about something they own versus telling someone about something they don't, it's quite different. And so a small investment, in this case, focused on investments, is a small ticket to an engaged customer and a sort of superpowered learning experience. I remember my first investment. It was a learning experience. I lost all my money, and it wasn't a lot of money, which is a good thing. It's, I think it's good to start small. It's good to start early, and people start looking at things differently when they're, an investor. They have skin in the game, and we actually think at Acorns the paradigm shift for customers that see themselves as investors is probably just as powerful as the money that they can make over the long term if they're investing. If you see yourself as an investor, as future rich, and you learn about how compound interest can work for you, then it's easier to understand how it can maybe work against you. And so, in terms of education, there is so much opportunity, and understanding the special moments when you have a customer's attention and a compelling story, I think is important to really seize that opportunity. Having a page or a section of your site or app where there's just information isn't necessarily helpful. If you're telling your customer something, make sure that it's important. Is it worth their time to read it? People's time, it's very valuable. If you tell them something they already know or that isn't relevant, then you're wasting their time, and they're less likely to pay attention later. And Eli touched on it a little bit earlier. There's a difference between teaching a customer about something they need to do for themselves versus what you're doing for them. And if you have a product that's out there, that's going to be changing over time. If your product is expanding its services, then you're sort of balancing telling your customers and teaching your customers what you're not doing for them, what you are, and it's certainly not trivial.
One other thought on education and writing is, if you are going to go down that path and you're going to invest in it, and we've done a lot of that at Betterment, put resources around it. Hiring good writers, good copywriters, was one of the hardest things for us at Betterment for a long time, and it remains hard to find good copywriters in the space. And so if you find them, then I would draw them in and make use of them, and be aware that if you don't have dedicated resources for that, then that work is going to get distributed to other people on the team who are supposed to have other responsibilities, because everybody can write, some really well and some not as well, but it's something that everybody can pick up and do the work on. And so you have to be careful about that, and make sure that it doesn't become a drain on your resources.
And you have to be really careful about, the commitments that you make, promises, forward-looking statements. It's easy for, an aggressive marketer to get carried away maybe on sort of on promises of a product. And maybe if they've never worked in fintech or investments or banking, they may need a little bit extra mentorship on that side, because that's one line you can't cross, at least on the investment side, in terms of you can't promise people things that you can't promise, and you can't make them think that something's riskless when it isn't. And if you're only talking about things when they're good, and you don't talk about things when they're bad or when the market's down, you really poorly train your customers for market downturns or bad days or bad months and other things. And so having balance in terms of education, it's not always rainbows and butterflies. When it's up, maybe that's a good chance to explain that it's not always going to be up every day. And when it's down, explaining to your customers it's going to be down some days. Maybe if you tell your customers early on when they open an account that your account is working if it is going up and down in value, that means it's working. That's okay. That's a lot easier than telling them when it's up, then one day when it's down, making a big deal about it, and the customer's going to think the product's not working. And so if you have a product that's connected to the market, understanding or helping your customers understand that the product may still be working, even if the market's going up and down, I think is important. Certainly not easy necessarily.
And it's really important to put thoughtful process around how your content and writing team engages with your product team and your subject matter experts and your legal and compliance teams. Having a tight process around that will make everything work much better.
Eli was all of those in one person at the beginning.
And then when we had to distribute it out, we had some fits and starts, getting everybody to work harmoniously and not having things kind of cycle around for days without making progress. All right, let's see, are there some other questions?
Yeah, hi, Rashidi from KL. Welcome to KL, by the way. I think I've got 1 or 2 questions. Number 1 is, can you give an insight on your culture of innovation, Betterment and Acorns? 1. Question number 2, what sort of technology stack that do you use in-house? Specifically, do you what kind of AI, ML technology that you use for as part of your innovation?
Well, I think to your first question, which I believe is about sort of a culture of innovation at our companies, well, I think that the company is birthed on really its values to begin with, and innovation is a part of executing against those values and our mission. So at Acorns, our mission is to guide the financial best interest of the up and coming, beginning with the first step of investing with benevolence and courage, and designing an investment experience for those customers required innovative thinking. We didn't set out to build a new type of broker-dealer and a new type of investment experience. We wanted to guide our customer through the best experience possible to open an investment account. And we wanted them to do it on their phone, using within a few minutes, using information that's top of mind. We wanted them to do it earlier than they would have otherwise, and we want them to do it in the background of life. And so with those constraints, we had to be innovative. And I think that innovation really requires constraints like that. You know, you're given some constraints, some rules, and then you need to find a way to make it work. And turns out, for us to make it work in that situation, we had to be thoughtful about how people funded their accounts, what type of information we needed from them. We didn't want to have them to pull out a check, right? That wouldn't be information that's top of mind. We couldn't have any physical paper because it wouldn't really scale properly. We couldn't have a long sign-up process. We couldn't even ask them to pick the investments initially because it still wouldn't be 2 minutes. We had to really be honest about those constraints. And so I think, starting with your, values and mission, and what you want to execute against, and then looking at the constraints in terms of designing that initial experience will require innovation. But I think if you look at innovation first, I think that it's challenging to necessarily apply it effectively. There's lots of interesting technologies out there and interesting things you can make, but if you don't have that encapsulated in a customer-first experience, it can be difficult to, get a grip on it properly.
I think what I'd say is one, make sure that as your team grows, you're communicating on a very regular basis the vision, the mission of the organization, the origin story. So as people come in later, they continue to get infused with that innovative spirit from which the company started. I don't think there's any founders or really early team members who aren't going to come at it with an innovative approach. So it's about how do we make sure that as the team grows, that sense continues. And then I'd say, experiment with your organizational structure and design. Try different approaches to organizing teams, different sizes, cross-functional or single functional. Try exercises like hackathons. Look for input and feedback from the team. All those things I think can help to keep an organization, light on its feet when it comes to innovation.
And it's easier with a smaller number of people. So starting off with too many people can be challenging. So, individuals and small groups can think of really interesting things and maybe onto something. We've had hackathons and other things at Acorns, and some of the most interesting ideas have come from individual engineers that have, worked over a weekend on an idea. And, we think about things individually, so it kind of makes sense that some good ideas would come from, individual introspection and reflection.
Sometimes that gives the team an opportunity to work on a pet idea, a pet project that you're just not going to carve out space for in a more organized, long-form roadmap. I've seen. Listen, we've tried it a bunch of ways at my companies, and sometimes it's really successful, and sometimes the team comes back and says, it was fun to do that, but we spent 3 days, and I've still got all this other work that I didn't get to. I wish we had that time back.
Yeah, so deadlines are important too.
Yeah. Where else? I think I saw. Let's go over here. And then we'll come back there after.
Okay, it's not meant to grab mics, I thought. Through the journey of the whole entrepreneurships, have you ever thought of giving up? If so, what keeps you going?
Oh, many times. It's very hard, but it's also, if it's something you really believe in, and you don't see another solution out there, then it can be more motivating to get back up and make sure that you can really see it through. It's somewhat easy to build technology. It's difficult to work with people. And so the hard parts about building and scaling the business are really related to how you work with others and making sure people can get along. The quickest way to break an early stage company is people not getting along. That's the number one reason companies fail. And then running out of money is after that. But a lot of companies with a lot of money break. And so, it's normal to doubt yourself. I certainly did many times. And a lot of the things that seem impossible, insurmountable, are really good things to focus on because they are. They're always something that can actually be fixed. It may require time. Usually it requires time, some patience. Spending time on something, even if you make slow progress, you can make progress. And if you have to get some other people to believe in it too, to work with others or raise some more money, that can be done. Take a deep breath, look at the options you have in front of you, and if I look back at all those hugely frustrating moments where I'm like, this is impossible, it was usually right before building the most valuable parts of the business. And it's those moments, those impossible, I want to give up, those are the really special parts of the business because those are the parts where most people do give up. But if you can, resolve to push through that, you may end up building something that's unique and valuable that most people wouldn't have pushed through. And it's very rare to encounter like a truly challenging problem if you break it into small pieces. And so, our building a self-clearing broker-dealer seemed impossible. And no, it took time, and it was very tedious, and thank God we did it. And if we had another way, I probably wouldn't have done it, and the company probably wouldn't be where it is today. So thank God we sort of encountered that moment where I was like, damn it, can we do this? So, good question.
Yeah, I mean, obviously it's a big roller coaster in the early stages of building a company. I do think it smooths out, with some progress and with building out the team. You get a little breathing room. I think mental exercises can be really helpful when you hit the low points in the roller coaster, and I think stepping back maybe and thinking about, okay, this is bad, this is not where we want to be, and trying to figure out what things could happen from here that could be a favorable turn of events. Thinking about those, assessing how realistic they are, and then. If it still feels realistic, you still have conviction that those things can happen to right the ship, then you should keep going. If you with a level head can size up that those things are really unlikely, then you have to reassess. I think this is another reason why it's great to have a co-founder. Yeah,
I agree on the co-founder front, because having someone that can, usually you're not both like that at the same time, but even if you are, it's usually a more reflective experience. But a little anecdote from Acorns too on that. In the early days, we built a very early prototype on PayPal, actually. We wanted to get in touch with PayPal because we thought that PayPal would be a great partner for us. And this is really before we did our first significant round of funding. This is, right after we got started. We couldn't get a hold of PayPal. We called like a customer service center to try and get through to someone. And they kind of took us to a dead end, and they were told we couldn't use the product, and we were misusing it. It was this whole thing. And 3 years later, they led a round of funding, and we got connected with the right people. And that first product, it looked terrible. But our thinking was in the right place, and we didn't give up. And it's okay. There's a lot of stuff that you're going to think like, oh, this is so embarrassing. It's so embarrassing. It's so embarrassing. But that's just how it is. And it's not, no one else is pointing and being like, oh, look at you trying to do things. You're just going to be hard on yourself. So, yeah.
So I think I promised we'd go to the back. Right. Yes, you, sir.
right. Hi, guys. Thank you very much for sharing with us today. My name is Ahmed. I'm actually from Atlanta, Georgia, so it's nice to see you guys on this side of the water. I've been involved with Fintech for probably the last 4 years. I did my master's in Islamic finance, and I wrote a thesis about crowdfunding for SME development in this part of the world. And at that time, I was kind of like alone because in my university, nobody had ever wrote on that topic. But that's just a little bit of background. 4 years later, I've worked in a fintech startup, and I got a little experience now doing consulting. And since you're in this part of the world, I wanted to ask you, I'm sure you've probably heard of Islamic finance, right? So I wanted to ask, have you guys considered exploring offering some options within that space? Because I've actually really wanted to use Acorns. I've been telling people about how great the model is and how it opens things up to millennials. But I can't actually use it myself because some of the investments go into things that are what we call not as compliant in terms of Sharia for interest and stuff like that. So have you guys, you're the leaders, and this is like a dream come true to meet you guys. So firstly, have you have thought about this, or are you exploring it, or do you need some help? I'm happy to help you with that. And the second one, I'm a consultant. Second one is more on experience that I had, working in a startup, which is breaking bad news to people who are investing. So you're dealing with micro investors, and sometimes micro investors are more picky than big investors. So how do you manage the emotions and things when things get a little bit bumpy? If a certain tweet comes out and the market goes crazy, how do you manage breaking news, or do you just leave things, you don't make news inside of your platforms? Those are my two questions. Thank you very much.
Thank you. Great questions. On the first point, we've been talking about Islamic finance increasingly. I feel like you brought it up to me initially.
Yep.
You're the one
That's right.
that brought up the idea, or not the idea, but that it was something that we should take a closer look at.
There's a session on it today, is there not? Is that right?
And as we've started to look at the impact of technology and on investing around the world, and as we spent more time overseas, it's come up as well. And I think an interesting thing to think about is, a lot of companies, I think when they look at expanding around the world, they think of, slapping their logo on something and just growing. And one thing we found is that, when you find really passionate founders and partners, that you tend to find the right partners to expand internationally, and they tend to have their own ideas. And so listening closely is important. So that'd be something really interesting to talk about and learn more about. I know there's a New York startup that I think started in that space, in robo-advising, in sort of a compliant fashion, which is interesting. And I think on the second, what was the second question again? I liked it. I just oh, breaking bad news. Great question. So it's about transparency. In the beginning, if you set expectations properly, then it shouldn't be a shock. It still may be uncomfortable. And I think a customer experiencing discomfort when the market goes down is important. You can't escape that. If you're losing money, it shouldn't necessarily feel good. If your focus is on the long term, of course, it can be seen as a bearable step on the way. But the first time you have an investment that goes down in value, these are learning opportunities. And if people can really take to heart those learning opportunities, when they're young or when they're growing, when they're building their wealth, instead of just when they have it, then they'll make smarter investors. And instead of having people that they invest their nest egg, that's the first time they've invested, the market goes down, they freak out, they sell everything, that's a pretty terrible experience. But if someone is a micro-investor and they're getting started and they experience their first market downturn, and maybe they sell a little bit and they regret it, or maybe they keep investing through it, but if they spend some time on it, they'll see that, oh, okay, markets come back. or if it goes up, markets pull back, they'll actually take away some lessons on, the market and how it moves over time, and hopefully become smarter instead of paying for those lessons sort of when the stakes are much higher.
Yeah, I think it's, have that conversation at the start, as Jeff has already said, right? It's the most important thing, start the dialogue with your customers from the very beginning that they're investing and that there's volatility involved.
Yeah.
I think we've got time for maybe one, maybe two more.
A quick one. One last question. Open-ended questions. How do you position human to supervise or to manage algorithm or bots or machines in both companies? I mean, in your experience, this is in relation to Brexit suspension trading from your Betterment history in 2016. Maybe you can share some points. How do you create that executive decisions to suspend trading from your point of view? Betterment and Acorns, maybe can share how do you positions human capital to supervise bots or machines or algorithm for that matter, you know what I mean?
Okay, so how our sort of investment advice and investment committee complements our automated strategies? So we automate investing similar to Betterment. And we help people automatically find money to invest. We help automatically rebalance the portfolios, reconstruct the portfolios. We also have things like found money and other opportunities where, if you're spending with certain retailers, we'll convert certain cash back rewards into investments. Our goal is to find as much money for you as we can, even your own money for you, and then help you build wealth over time. So on the investment side, it's really important because we have an investment committee. We were lucky to have a Nobel Prize-winning economist join early, which really helped us communicate that. And he won his Nobel Prize for modern portfolio theory, which isn't that modern. It's a pretty simple investment strategy around sort of incorporating uncorrelated assets. And so we've really diversification is the hallmark there. And we diversify across assets using ETFs. And the communication of that to our customers is important because we want our customers to decide, do I invest, not what do I invest in. Doesn't mean our customers aren't going to go pick individual stocks. They may go do that on a separate platform, and we're supportive of that. But I think we really lay out, okay, who's part of this committee to decide the investments, how is this sort of strategy developed, and how is it sort of incorporated and executed using technology. It's pretty simple and straightforward. I think the hard part is how you communicate it to the customers versus how you actually build it out on the technology side. And so we have regular meetings with the investment committee, want to make sure they understand what the technology is doing, and also make sure they understand how we're communicating it to the public. So, for example, if we have portfolios that recommend, say 4.52, percent should be allocated to, small cap stocks in the U.S. Like they would say, hey, don't use 4.52 because you're implying a level of precision that doesn't really exist here for the customers. And things like that. So it's really connected holistically to like what the customers see and how we present it, and not just sort of on the back end and how these systems are designed, if that makes sense.
We honestly don't get asked this question by our customers very much. We do by some regulators. The answer is pretty simple, right? We have a fully automated system. We explain how it works, very transparent about what the trading methodology is, and then we have some brakes on the system. So if there are certain triggers in markets and prices and in trading activity and liquidity, then we'll hit the pause button and let the team kind of weigh in and assess. I think so. We have a minute left. Do we have one last question? Let's go over here.
Hi, my name is Azrul. I have one question though. Lately, we are seeing more and more financial institutions and banks trying their hands in fintech, maybe set up their own, sites, startups or something. So, how do you see this kind of setup working for large institution and banking? Would you recommend? Would you see any pitfall that they might come across, and any advice?
I've not seen it go particularly well for big banks and institutions. I think that there's opportunity there for them. It's very difficult. You have a classic innovator's dilemma. It's just not an environment that is well suited to innovation. I'm not saying it can't be overcome, but it's difficult. I think a partnership approach is much more interesting for banks and large corporations.
And partnerships are perilous for very early stage companies. So before your sort of business is fully formed or even semi-fully formed, it's difficult to strike a partnership with a much larger company. And also you want to make sure you're in charge of your own destiny. And so the company should be a vehicle to build and sustain a great product, and a partnership should do the same.
Okay, right on time. Thank you, everybody. It's been great spending this time with you. Look forward to see you around the rest of the conference.